At the end of July, probably by the time you watch this video, 8 banks begin pushing millions of retail investors out of paper gold. They can't do it, they can't buy it, they can't sell it, they can't trade it. They have to either sell it, they have to close it, or they got to take delivery of the gold. This means that China's closing the last paper leak in its own system. So that inside China, if you want exposure to gold, you have to buy the physical metal of gold. Why? Again, take delivery. A small percentage of people taking delivery to force the price higher. So what's happening? It's happening right now. The question is, what does gold actually cost? What does gold actually cost once the physical sets the price over the paper?
A seismic shift is rocking global precious metals as banking institutions restrict retail access to paper contracts, forcing investors to either take physical delivery or liquidate positions. This sudden suppression of synthetic trading marks a decisive turning point in how gold is valued globally. Markmoss, a prominent macro strategist and author, contends that China is systematically shutting down paper leverage to anchor valuations directly to physical metal. As Eastern exchanges demand tangible settlement, the price gap between paper derivatives and physical bullion will drive arbitrageurs to buy cheap paper contracts and drain Western vaults. From an analytical perspective, this shift signifies more than routine arbitrage. It represents a geopolitical transfer of pricing power from Western paper markets to Eastern physical demand. Gold is predicted to undergo a dramatic price surge as paper spot rates yield to physical vault constraints. Investors who recognize this structural transition early can safeguard their wealth against fiat debasement. Now, we present the clips from his interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
So Shanghai's price is anchored to physical reality. And when we have two prices that exist across the world for the same thing, for the same gold, one's anchored and one's not, what's going to happen? Well, the traders are going to come out to play. That gap becomes a magnet for who? For the arbitrage traders. So September 14th, 2023, Shanghai traded $121.20 an ounce over the London price. So guess who's going to come out to play? The traders. The traders are going to go buy where gold is cheap, and they're going to go sell it where gold is expensive, of course. And when they do that, they drag the price towards the actual physical price, okay? And some may call that attack. Maybe it is. It's not an attack. It's just arbitrage, right? That's what we do. We buy low, we sell high, and they were doing China's work for them. This is what China set this up to do. Then on June 26, 2025, the third piece dropped. Hong Kong launches offshore gold contracts linked to the SGE, the Shanghai Gold Exchange pricing. Okay, now these are settled in physical metal from a bank in China vault in Hong Kong. Now, if you've been following all of this, what this means is that for the first time now, international money, dollars with no Chinese bank account required, can now buy gold priced in a physically settled system. Now, they can do that instead of a papered one, all right? This is exactly how China's been repricing gold. Now, the question is, maybe you're asking, is physical demand really strong enough to move the Western system along? Well, we can already see the answer to that. We can already see the experiments already run. Late 2024, we saw Trump's tariff scare that scared the whole world, and there was big tariffs that were put on gold. And so we saw this all of a sudden start pulling gold out of London and back to the United States. As a matter of fact, 790 tons moved from London over into New York just from that alone. We're talking almost $80 billion in just 4 months. This wasn't about China. This was just Western traders front-running attacks. And so this proves how valid this is. And now that right there was enough to buckle London. We saw the Bank of England's withdrawal queue went from 1 week to get the gold out all the way up to 8 weeks. That's how far they got behind. Well, they probably weren't behind processing orders. They were getting behind on finding enough of the physical metal. We saw lease rates quote through the roof. We went from under 0.5% to over 10%. And we're talking about the deepest gold market on earth. We're not talking about a small pool. The deepest gold market on earth strained to produce the metal that was supposed to be in its custody. And this was just from a fraction of the claims that asked for delivery. So that was just barely even a stress test. But watch what the patient money is doing right now. The central banks, they're doing something different. The central banks just keep on buying the physical gold no matter what. We're talking about over 1,000 tons per year, 2022, 2023, 2024, 2025, a little bit less than 1,000. For Q1 of 2026, we're on pace to hit that number again. Now, one key date that's important is look when this really started, 2022. This is the date, February 2022, as a matter of fact, is when the West froze Russia's foreign exchange reserves. This was the moment where every central bank on earth learned the same lesson the same day. A reserve that somebody else can freeze isn't a reserve, right? It's permission to use that money if they want to give it back to you. And so what did? They started buying gold. We want the gold in our central bank vaults. And they've been buying it, and they've been buying it. And they've been buying it from the price of $2,000, $3,000, $4,000, $5,000. Why? Because the price doesn't matter to them. They're not trading it. What they're doing is they're converting the US Treasuries into gold. And you can see where all that physical buying has taken us. We can see by the end of last year, the amount of physical gold being held at central banks up to 27%, while US Treasuries has dropped to 22%. For the first time in the modern era, the world's central banks hold more gold than US Treasuries. And that's not just my chart. It's from the European Central Bank, the ECB. In their own words, gold now surpasses both the euro and US Treasuries. Now, the ECB, they put out a disclaimer, and they say this is because gold went up in value. It's not that they bought more gold, it's that gold has been repriced. And so now, of course, based off of current values, it's more gold. Sure, okay, but they didn't rebalance. They didn't sell it down to keep the balance proper, to keep US Treasuries or euros at a higher level, right? Every treasury manager watched gold triple, and they didn't trim it. They didn't trim it back into balance. They let the winner run in the position. Why? Because it's not a trade. It's a transfer. Now, if you want to know what they expect next, then what we want to do is we want to watch the construction. We want to watch the leading indicators. And we can see in Hong Kong, they've been building a vault, an airport vault, 200 tons to 1,000-ton capacity. All right. Now, the city's stated goal is to target over 2,000 tons of storage within 3 years. So what does this tell us? Well, you build vaults into the future, 3 years into the future, for what you're expecting the demand to be into the future. So what this means is that they're expecting to have over 2,000 tons there in just the next 3 years. And of course, paper gold doesn't need a vault. Now, this is old news if you've been paying attention, right? They told us that this was gonna happen. They signaled this would happen at least over a dozen years ago. We saw the chairman of the Shanghai Gold Exchange in the People's Daily. He said that gold is priced in the West, but it's consumed in the East. So what he's saying is, in the East, over here in Asia, in China, we're the buyers, we're the consumers, we're the buyers of the gold. But even though we're buying the gold, we don't set the price. The West was. And they saw what was happening, and they devised a plan to fix it, to bring the price of gold back to a real global price. Okay, so let's go back to today. At the end of July, probably by the time you watch this video, 8 banks begin pushing millions of retail investors out of paper gold. They can't do it, they can't buy it, they can't sell it, they can't trade it. They have to either sell it, they have to close it, or they got to take delivery of the gold. This means that China's closing the last paper leak in its own system. So that inside China, if you want exposure to gold, you have to buy the physical metal of gold. Why? Again, take delivery. A small percentage of people taking delivery to force the price higher. So what's happening? It's happening right now. The question is, what does gold actually cost? What does gold actually cost once the physical sets the price over the paper?
Central bank gold purchases have shattered historical records, exceeding 1,000 tons annually as sovereign entities aggressively reduce U.S. Treasury exposure. Following the 2022 freezing of foreign exchange reserves, central bank balance sheets shifted dramatically, resulting in gold holdings surpassing U.S. debt instruments for the first time in modern history. This sovereign transition illustrates a critical macro reality. Fiat reserve currencies are increasingly viewed as counterparty liabilities rather than risk-free assets. By converting debt claims into unfreezable physical bullion, nation-states are building defensive moats against monetary weaponization. This ongoing central bank accumulation predicts a permanent upward revaluation of physical gold and silver, as paper spot prices fail to reflect true physical scarcity. As vault supplies tighten further across global exchanges, paper markets will ultimately capitulate to physical supply realities. Now, let's get back to the interview.
In 1976, the average home price in the United States was $48,000. Today, it's $540,000, up more than 10 times, okay? But if you look at the price of the same house priced in gold in 1976, it was 384 ounces, about 385 ounces of gold. Today, it's about 133 ounces of gold. So what does this show us? It shows the house didn't get cheaper. What you measure them in broke. If I measure them in dollars, they got more expensive. If I measure them in gold, they got way cheaper. Same story with a car. Look at this. The average new car was $5,000. How can you even buy a car for that? $5,400, okay? And then in 2006, it's now about $50,000, $49,000. That's in dollars. But if we go back to gold, we can see the same thing. In 1976, it was 43 ounces of gold. Today, it's 12 ounces of gold. We can see the same thing with gasoline. Look at this. Gasoline back in 1976 was 61 cents. Today, it's about $4 a gallon. And in gold, we could get 200 gallons with an ounce. And today, we can get over 1,000 gallons with a single ounce, 5 times the gas. So as you can see, whether it's homes or cars or gasoline, if you measure them in dollars, they got more expensive. We measure them in gold, everything else has gotten cheaper over time because that's what's supposed to happen. When productivity rises, things are supposed to get cheaper. Your money is supposed to buy you more things in the future and not less. Your life is supposed to get easier and not harder. Now, if you think this repricing stops at gold, well, hang on, because it's already starting to jump into all the other markets. In February, we saw the price of silver in Shanghai trade 29% over the COMEX price. U.S. dealers were scrambling to get the silver. Physical went up as much as $8 to $17 an ounce over the paper spot price because when the physical price and the paper price disagree, guess which one wins out? The physical, as long as people are demanding it. So here's what I'm actually watching as all this plays out. Like I said, we've been talking about this for years. So here's the signpost that I'm watching. There's 5 things that I'm watching. Okay, number 1, the Shanghai premium over the London price, okay? As I said, the Shanghai premium, which is physically settled, over the London price, which is paper, okay? That's the pull. That's pulling things along. Number 2, I wanna look at the Bank of England Q and the lease rates that they have, all right? That's the strain. When the Bank of England, the largest, the deepest gold market in the world, starts running out, not able to fill orders, having to borrow gold to fill it, okay, that's the strain on the system. Third, I wanna watch central bank purchases every single quarter. That's the conversion, right? Central banks are not trading, they're converting the treasuries into gold. We wanna watch that, keep an eye on that. We will see number 4, Hong Kong's vault build out, right? So as they said, they wanna get to 2,000 ton target within 3 years. This is the infrastructure for all this to happen. And then of course, number 5, we wanna see more Chinese banks closing the paper gold products and pushing people back into the physical. That's the consolidation of the system. So when all of these things start moving together, you're watching the repricing accelerate in real time. Actually, let me go back. Screenshot this one real quick. We'll put it up on the screen for you.
Evaluating wealth through hard assets reveals the severe purchasing power erosion of fiat currencies over recent decades. In 1976, an average American home cost 385 ounces of gold, whereas today it requires only about 133 ounces. Similarly, 1 ounce of gold buys over 1,000 gallons of gasoline today, compared to just 200 gallons 50 years ago. This stark contrast highlights a fundamental economic truth. Technological innovation and rising industrial productivity should naturally make living standards more affordable, yet fiat debasement masks these gains behind nominal price inflation. Gold acts as an accurate ruler, exposing currency debasement while preserving genuine purchasing power across generations. Looking ahead, international monetary systems are predicted to experience an accelerating repricing event as paper derivative markets lose credibility against physical demand. Monitoring vault expansion targets, lease rates, and delivery queues will provide early indicators of this systemic financial transition. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.